We'll get kicked off and get started. So for all of you who are new to the Central New Jersey Compliance Group, we really need to rebrand this now. Again, talking about remote. The group was formed a few years back. I don't know, probably like 7 years now. Dan O'Donnell, who I know is on the line with us and as attendee, was instrumental in helping Mercadien get that started and kicked off the ground. And it started as a smaller group within our office that we met and did these types of presentations and had some roundtables. And then over the years, it's grown. And then obviously over the last year or 9 months or so with the pandemic, we've transitioned it solely to this online forum. So really, Central New Jersey doesn't really make too much sense at this point in time because really anybody from around the country can be joining in. So definitely, thank you for your continued interest in the group and for attending today. The mission of the group is really to discuss strategies for handling new regulatory requirements, industry best practices, things that we're seeing at Mercadien that we think is really valuable to our clients and the industry. We like to bring that to everybody. So we'll, put on a session, a seminar like today, and discuss those focuses, issues, and trends. But really, it's a way for us to network. It is harder right now to network in a remote capacity. So again, you do have the option to ask questions, raise hands. I know it's a little tough in this forum, but we do like to try to keep it a little bit more informal and more in the conversational range. But again, I know it's harder, and we're still grappling with making it very, very much that same as in person. But definitely use the chat, raise your hand. We can see when you raise your hand, and Ashley can definitely unmute you for discussion, or you can send it in via the chat. So we offer CPE for this session. So what you would need to do is throughout the session, you'll see some polling questions that come up. The polling questions, when they do appear, you need to answer them. And also at the end, you'll receive an evaluation. So you need to fill that out along with the polling questions, and then we will then send you a CPE certificate. And also for those of you who do not know me and or the firm, Mercadien has been around for about 55 to 60 years now. I lose track of time. Everything moves very quickly. But we've been around for a long time, and Mercadien has many different accounting CPA facets to it. But one of them is our financial institution services group, where we provide the banking industry different risk management services, which include co and outsourced internal audit, second line of defense compliance services, BSA related services, loan reviews, and the like. My name is Sal Zarilli, and I'm a partner at the firm, and I head up our financial institutions group. And today we'll be talking on common audit findings in the PPP and other pandemic relief programs. And the presentation will be given by Melissa Correa, who is a manager, and David Healy, who was one of our supervising seniors within the FI practice. So with that, I'll turn it over to Melissa and David.
Okay. As Sal was mentioning, we try and pick topics that are timely, just because, the group is really meant to be interactive. In person, it was nice because, our attendees were able to kind of share what's going on at their institution and really be able to even network afterward. So again, we encourage, feedback, throughout the presentation. As he mentioned, the focus of today's presentation is really to talk through some of the things that we're starting to see now that, the dust has settled, there's transactions in pipelines, and we're in middle of audits. We've visited a couple of our clients, we're, been attending multiple focus groups, and really we've gotten a lot of feedback of what's happening in, at different institutions. So we wanted to share that with everybody so that one, we can take them as lessons learned, and then two, try and learn from, our mistakes going forward. One thing to note is that, going into the second wave of the pandemic now, we don't know if these were one-time type of programs, or if they will get, further funding. There'll be new types of programs. So even though, some of the audit findings, are really, you can't really remediate, these one-time occurrences, you can't go back. We can definitely, update our processes going forward if there happens to be additional offerings. So, we want to be able to give you that feedback. So we'll talk about a couple of things. We'll first start with going over just different overviews of the different pandemic relief activities that we saw, what was put out by regulators. We'll talk about audit pitfalls specific to those activities. We'll do a high level, skim over TDRs and kind of what issues could, are there. Talk about internal control systems, and really the presentation is going to be audit focused or compliance review, kind of interchangeably, but really that's the scope we want to focus on as an auditor. What are we seeing, and then you guys as the managers of the different functions, what you can do to help mitigate some of these activities. Then the second part of the presentation will focus on the PPP program. We'll start with a high-level overview of the program, talk about common audit findings and their impact to your risk management strategies, and then we'll kind of end with a Q&A session. Hopefully there'll be something in the pipeline for us to discuss. But again, if you have things as we're going through them, please feel free to pause. So I guess just really quickly, the pandemic relief activities varied. Primarily, this list was what regulators said, institutions should have, relaxing due dates for loan payments, extending grace periods, doing loan modifications on existing loans, easing credit card limits. There was also extensions of new credit under PPP programs. There are other loan initiatives outside of PPP programs. So, for example, there was some additional SBA programs that came out that were additional options outside of PPP. So there was a lot of things that could have been happening when extending new credit outside of this. So all inclusive, in this platform here. A very common thing we also saw was waiving of late fees and other fees. Deferment, we saw a lot of skipping of payments, putting loans on forbearance. That was a very common relief measure. Of course, the guidance from the regulators was definitely to ensure that if we were offering any of these concessions to loan customers, that we delayed the submission of delinquency notification to credit bureaus. All of this really aimed on ensuring that we capture this as kind of a temporary event, right? That it's not because anything that the borrower had control over, it's really more circumstantial. So allowing them to be able to have this immediate short-term relief, and then once it's over, them having the ability to kind of just pick up where they left off. So this is kind of the parameters of what we're, starting to look at. Of course, all of this, one thing that we wanted to make sure everybody kept in mind was how you offered these different concessions to different borrowers. Being able to be consistent was important because there's definitely fair lending implications to a lot of the ways that these programs were rolled out, the types of borrowers that affected. I think in general, we didn't see really a concern here. I think, most of our banks were very focus on helping all types of, their customers, whether it be consumer, commercial. Really, there was maybe some differences in, approaches based on the type of customer, but definitely, we saw a lot of opportunity for everybody to be able to have access to these programs. Then we had, specific forbearance measures that the regulators were very prescriptive about. Here in this slide, I just kind of want to point out that a lot of the ones that we talked about in the previous slide, there was not a lot of specific requirements on the how-tos and the requirements from the regulators. However, in the CARES Act, anything that was a federally backed mortgage did have very specific and prescriptive guidance, right? So of course, from an audit perspective, this is what we test against. So, I would just encourage that if you haven't already, start looking at your programs compared to the different, points that the regulators came out with, because they were very specific on, how to book these, what you could charge. For example, you couldn't have additional interest, fees, or penalties charged during forbearance periods. They give different options on how, the ability to repay for missed payments. And then, what the refinance looks like after that initial forbearance, what you were able to do. So very prescriptive in nature. So, from an audit perspective, if this is part of your portfolio, I would start there and looking at the regulatory guidance that came out related to that. Next, we had some guidance, that was state specific, right? So we had New York, that was probably one of the states that was a little bit more prescriptive. They did have specific, moratoriums on evictions and foreclosures that kept getting extended as we saw. They initially, set the bar at, a certain date, then kept extending it because COVID kind of the wave has lasted longer than we thought. So if you are in New York and you do have loans that are covered, we want to make sure that you understand that these moratoriums have not, where they are in light of where your actions are, because these were a little bit more prescriptive. Whereas, New Jersey was, they also gave us a lot of guidance. They also said, here's examples of things we want you to do, right? You need to be working with your customer. You need to be making sure that you're offering them relief. And so they gave us a laundry list of things to do. So, make sure that you're familiar with them, if you are a New Jersey bank. So different states had different guidance. We only focus right now on 2, just as an example of what we saw. But really here is where, the starting points. So where are we as far as audit? So this is kind of what we're seeing in the field now when it comes to pandemic relief activities. So one of the things that we're seeing is inconsistencies in, customer communication. For us, we want to make sure that there's open lines of communications throughout the process with your customer. How accessible are you to them? How much follow-up is there? Are you providing them updates on, where their applications are, where their requests are? So we want to make sure that, from customer communication, you have a good audit trail of those initiatives because we really don't know what the examiners are going to be focusing on when they come in for their exams. So we want to make sure that, we have good audit trails of this. The second thing that we're seeing is inconsistent documentation standards. And what I mean about that is that, different banks had different levels of volume. And so, of course, we expected that banks that have more activity, usually the level of documentation is probably not as robust as, a bank with small, less activity, just because, there's the added pressure of, managing pipelines and dealing with volume. So we are seeing that. We're also seeing some inconsistencies in approvals. So we see, we've seen some institutions that have very formal approval processes of, modifications, for example. They all went to committee, they all got approved and looked at individually, whereas other institutions had more lax approval processes where, maybe they delegated approval authority to one individual and, they kind of just kept working the pipeline. So it's different. So, the inconsistency is not necessarily an audit issue. Because it's going to vary based on the institution and what the circumstances are. But as an auditor, I'm looking for first making sure that everything's in line with your policy, right? Or your procedures, and that you followed that process for all loans. And then I want to understand, what drove your documentation standards. So making sure that you have that methodology well documented is probably a good idea, so that you can either give, your auditor or your examiner be able to answer those questions. The other thing that we've seen is COVID attestations, some inconsistencies here. If you recall in the slides, I know we moved really quickly through them, but in the COVID slides, in the CARES Act slides, attestations were one of the minimum, that's really all that was required, is that, the customer attests that they were going through some hardship that was related to COVID. How you capture that, we're seeing different levels of documentation. So we're seeing some banks are documenting those attestations just orally, maybe in a note in their account. Others, we're seeing that there's actually like a documented form that the customer signs, returns, just a little bit stronger audit trail. So I think, looking at what standard your bank set is important, because, one of the things that we see, or we'd like to see, right, when it comes to the attestation, is understanding that what type of relief you offered, right? Because if it's a COVID, affected customer, the attestation helps build the audit trail that they got, any COVID specific measures. However, if it's a customer that maybe had a more permanent type of issue that maybe should have been put into your regular loan modification queue, maybe the attestation kind of helps distinguish the two customers. So, that's really kind of where we're looking at it from is, did you do a short-term, type of relief, or are you really understanding that your customer maybe needs some more long-term impact, more permanent types of solution? So, that's definitely something that you want to take a look at. The adverse action notification process. So here, what we want to do is we want to just remind everybody in the group that, when a customer is asking for, relief, depending on what it is, if it's a waiving a late fee, that really is not a formal, your credit decision you're making, right? However, if they're asking for, a permanent loan modification, if they're asking for a PPP loan, there could be adverse action notification requirements that are triggered. So we want to make sure that, you had a process in place to send them out. And then also that you had a process to really identify the reason that adverse action was taken and that it was in line with regulatory guidance. So, for example, the programs were built to be kind of like be able to be as flexible as possible, right? So there should have been very little bit of adverse action happening. However, in the PPP program, one example is that at the beginning, there was a lot of restrictions on the type of customers that were eligible, right? So making sure that your adverse action notice captured that was the reason for the denial, is important. So, from adverse action notifications, we're looking at not only did you send them out, but also is the content of the notification correct and in line with regulatory guidance. The other thing that we are seeing happening in the field is that the pipeline management is really important. And so because you're getting a lot of requests for COVID relief, you're also getting, a bunch of PPP applications. Well, you had PPP applications, but then also what we're seeing is that there's a lot of refinancing occurring. So basically everyone's pipelines have exploded. And so pipeline management is critical because now there's some, there could be adverse consequences. So we've seen some institutions that maybe are past, the decisioning process from a Reg B perspective, that we catch it when we start looking at some of these adverse notices. We see that, the decisioning wasn't being done timely. And it's all because, pipeline are so full and you may not have the bandwidth from an employee perspective just to process all these transactions because they're all affecting a lot of the similar departments. So things that we're seeing there. Loan modification agreements. So we've seen some variation in the field. We've seen some institutions who have very formal loan modifications that document the period of forbearance, what repayment's going to look like. Customer signs off, very, very formal, very traditional. So we've seen that. And then we've seen some more non-traditional, emails, confirming. We've seen some that, maybe it's a modification agreement that lacks the customer's signature. It's more like explaining the results of the modification to the customer, but it lacks, a sign off, a formal approval. And although we know that your customer was the one that requested this modification, it's probably just good practice to have a formal signed agreement for any modifications, because if it happens that your customer, has a continued effective from the COVID, from COVID, and you happen to go into, foreclosure later in the line, it may come back that, you have very little recourse because there's no contractual agreements. So, loan modification agreements are a contract. So just think of it from that perspective. We talked a little bit about timeliness of the process and temporary versus permanent. From TDR designation here, what we would say is that in the next 2 slides, we'll give you an overview of what the TDR rules were. Making sure that if you are doing a loan modification that is TDR exempt is important, because if you aren't familiar with the rules, you could be just passing on a lot of loans that actually are TDRs. So just making sure that, we understand which type of loans are exempt from TDR designation and which ones aren't, so that we, perform the right measurement. And then the last piece really are interrelated. It's system setup, credit reporting, and governance of the whole process. So making sure that your file maintenance is well documented. Making sure that whatever file maintenance you did also is affecting credit reporting, so that you're not inadvertently reporting someone as past due when they're in a forbearance. So that's going to be making verification. And then also from a governance perspective, being able to report on metrics. So we want to make sure that management understands the volume and the scope of what you offered, how many loans were deferred, how many borrowers, what was the impact, how many did you decline, because all of these metrics are important measurements to understand the impact to your customer base. And we anticipate that regulators are going to be looking for that when they come on site. They're going to want to look at these trends. So just making sure that you have well-documented reporting structures is going to be key. Here's just an overview of the troubled debt restructuring rules. I'm not going to focus too much on them. Again, primarily the focus is to ensure that you understand when a loan is considered a TDR, and then which loans based on CARES Act guidance were exempt from that treatment. Getting close to year end, everybody's looking at financial statements, everyone's looking at their allowance for loan loss. So making sure that you understand the distinction could have an impact on your allowance calculation. So if you're in the accounting department, make sure that you're very familiar and well-versed with these rules. If not you, then make sure that your accounting department is well-versed. And then here is just a quick overview of what we're looking for as auditors, right? So we're looking for approvals in line with your policies and procedures, making sure your core systems are accurately reflected. We're doing regulatory reviews. We're comparing what you did against regulatory guidance. We're making sure that, from a pipeline management expertise, really staff levels, being able to manage the pipeline and understand the various rules. And then making sure that you had exercises to go back and evaluate the risk impact of all of these activities. So we're definitely looking at that, and then looking at collection efforts and what they look like post-pandemic. How did these processes change? Because now these customers, could be kind of stuck in the middle. And then of course, compliance with any government mandated programs, which is what David will start to talk about as he focuses on PPP programs.
Sure. So, from the Paycheck Protection Program, we know that it was, signed into law, back in, March 27, and it was a stimulus package to kind of help with the pandemic, and it created this new program. And, the new Paycheck Protection Program, was authorized the SBA, to guarantee all of the loans. It was an incentive to help, small businesses and, keep their workers on the payroll. And initially the program, rolled out with, $349 billion. And then there was an additional $310 billion that was added to it, which was really the second phase of this PPP program. So I know that, as things go with the SBA here, they kind of kept rolling out different FAQs, as the days went on with the program. And right now that 60% of it has to be used for payroll. And one of the things to note here is that the payments are deferred, and they have to have the forgiveness application submitted within 10 months of the completed covered period. And then once that happens, they're not required to make any payments until the forgiveness amount is remitted by the SBA. And, this was a change that I think just occurred, maybe a couple months ago, because it was formerly a 6 months. And, so when you're looking, at your system setups, as Melissa was talking earlier, it's really to understand that the system's not looking for a payment right away. There's no guarantee or collateral that's required. And depending on when the loan was done, before June 5th, it was a maturity date of the 2 years. But if it was after June 5th, it was a maturity date of 5 years. And then, you can have those borrowers that received a loan back in, the early part of the program say, no, I want the 5 years. And if your lender agrees to it. And this is something else that kind of goes back to the system setup, is looking at the maturity dates and really understanding, like, hey, is it a 2 years? Is it a 5 years? What does the borrower want? And of course, the loan had an interest rate of the 1%. And we'll talk a little bit more about the forgiveness as we move on. So here that, the borrower's eligible for forgiveness if they used 60% for payroll. And this is where some very important dates come in when looking at it from a forgiveness perspective and the risk here with the bank. February 15th is one of the key dates out of this program, because for interest payments to be used for forgiveness on a business mortgage obligation, they had to incur it before the February 15th deadline. The same thing on, business rent obligations or personal property. It all comes down to that February 15th deadline. Same goes for the utility payments here. So when looking at the forgiveness things, if a borrower received a loan before June 5th, they have the option to elect an 8 or a 24-week period. And then anything after June 5th, they have a 24-week period, which is considered their covered period. But that doesn't mean a borrower from the early part of the program from, April and May can't elect that 24-week period. So here, there's a lot of talk about how this works and a reduction in, full-time employees. If you're using the covered period or an alternated covered period. And for this purposes, you have to select a reference period. So, it's from February of 2019 through June, or January through February of 2020, or if you have a seasonal employer. So you kind of have to understand what the borrower is using for their reference period here and how they're calculating any reduction in a full-time employee. So here, if during the covered period, if your full-time employees was less than the reference period, then what happens here is the eligible expenses for forgiveness is reduced proportionally by the percentage of the reduction in the full-time employees. So we use an example here, 10 employees during your reference period, you declined it to, if it was declined down to 8 during that period. And then if it would equivalent, that is a 20% decline. And then only 80% of the other forgivable expense, other eligible expenses, and we'll talk about that in just a few slides, are available for forgiveness. And the same thing, full-time equivalent is 40 hours or more for each week. And it's a little confusing here with this whole reduction of full-time employees. So here, back in October, the SBA and Treasury decided to kind of make things a little bit easier for the lenders here. So they rolled out this new form, and the new form is 3508S, and it only applies to borrowers who had a loan of $50,000 or less. Or if it was a borrower with an affiliate received 2 million or greater, they're not able to use the form. So here, this form is supposed to make it easy, is that the borrower doesn't have to show the calculations to determine that the loan amount is forgiven. But if the SBA chooses to audit that loan, then they have to produce the documentation as part of the review. And for the banks, it's just the amount of the due diligence that you want to do and get comfortable with how they're calculating this forgiveness amount here.
Yeah, and just really quick on the different applications, we're kind of going easy to harder, more complex. One thing just to know, as David mentioned, is that there's specific eligibility requirements to be able to use each of, the forms themselves, and the level of due diligence changes as you switch form over form. So of course, this one that he talked about is the easiest one and most straightforward, and has the most flexible standard for banks as far as what their due diligence is. However, you want to make sure that your borrower met the eligibility requirements.
So for here, from a lender's perspective, you're just going to kind of confirm the receipt, making sure that, there's certifications that the borrower has to do. And, the level of due diligence really depends on the risk appetite for the bank here. Whether they're going to start, ticking and tying payroll and non-payroll costs, or if they're just going to kind of accept a reasonable amount here based on the due diligence the bank wants to do. The accurate calculation of the forgivable amount is responsibility of the borrower. They're attesting to it. And, here the borrower should not be getting for forgiveness without giving all the without giving all the required documentation to the lender. And, while using this simplified form here, as Melissa said, it's the easiest form. The lenders don't necessarily have to verify everything. It's just the level of risk that the bank wants to take on here. So in order to use this, the borrower, self-employed, independent contractor, a sole proprietor, no employees. There was no salary or wage reduction of 25%. They didn't reduce the number of employees or the average paid hours. And, they didn't, they were unable to operate during the covered period at the same business levels prior to that February 15th because of, various requirements and compliance with, governmental requirements here. So when when the borrowers are submitting these forgiveness forms, it really comes down to eligibility and making sure that they are eligible for that form.
Yeah, so this 3508 easy is kind of like the middle burden type of application. It's still pretty easy. This is the one we're seeing in the field now, only because, the 3508S is fairly new. It's only been rolled out for a month. So what we've seen is primarily this easy form. It's pretty straightforward because, if you look at the 3 different criteria, it really rules out anybody who had that reduction, that calculation of FTEs and the reduction in wages and salaries. So it's a little bit more straightforward. So this is one that we've seen in a lot of our smaller community banks.
So the 3508 is probably the hardest
Mhm.
form here. It's more robust and it's for individuals or businesses that aren't eligible to use a shorter form. There's a whole calculation for a full-time employee or salary and wage reduction. And there's enhanced due diligence that's going to be required with use of this form. So some of the things that we're seeing, as we work with our clients and kind of going through this, is the system set up, the deferral period, kind of going back and understanding that, hey, the borrower doesn't have to make a payment, as we talked about on a previous slide until, it's outside of, it's 10 months over their covered period, they have to submit the form. And then, it's once the SBA, remits payment for the forgiveness period here. And that's probably the most common one that we're seeing. And then we have some discrepancies, with the 1502 reporting and, when does the loan go on which, on which monthly 1502 report, depending on when the SBA issued it. And then, with levels of due diligence, as Melissa was saying earlier, this really just comes down to the risk appetite and how much, in some cases, it was a very formal process, went through committee. In other ones, it was, one or two individuals within the bank had the authority, to issue the loan there. And then the same thing with, the amount approved, and there was so much different guidance that went into things that, sometimes we were seeing that, not every eligible expense was, or eligible cost was captured within the loan. So here is where, the borrower is like, oh, I, may only want 100,000, but they were eligible for a higher amount here. With a Schedule C and they're your self-employed individuals, gross versus net. And this could have some implications on the forgiveness side. And when we get there, we'll talk about that. If you're only using the net instead of the gross. I know that everyone nowadays is working from home and they're like, oh, great, I work from home. I can include a home office expense. But with that, the SBA was very specific and had said that the only way you can claim a home office expense is if it was included as part of your 2019 tax return. If it wasn't claimed on your tax return, then it's ineligible to be claimed here. The employer paid federal income tax, we've seen, some of our clients try to include that in the loan amounts, and that's just not eligible. And then the new business and new rental agreement, that's another thing, as I had mentioned earlier, about that whole February 15th date. If it was after it, it couldn't be included, but if it was before, it could be.
Yeah. And the only other thing here is, all of these are tied to level of due diligence, right? So very complex rules, very detailed. I know a lot of lenders are not, tax individuals. So, we had to get very familiar with the rules, and we had to do a lot of research. So we understand that, depending on what the client gave you, sometimes these were hard to identify in the documentation itself. And then the last item on fraud, we haven't necessarily found fraud in any of the loans because a lot of our client base are, smaller community banks. A lot of them, kind of scoped their PPP lending program to be to their customer base. So they have, it went through their regular CIP procedures. And so they were very comfortable with who their customer was. But we are definitely, we watch the news and we know that fraud was definitely a concern, especially if you kind of had a large program that extended beyond your customer base. There's, you may be more susceptible to potential fraud.
So I know we're talking, this is all about common audit findings, but, throughout our audits and our reviews here, we did see some positive things. So in some cases we saw where, the lenders weren't sure on, if there was eligibility because, there was affiliated rules and they were kind of complex. So we were seeing, in some cases that the lender was proactively reaching out to the SBA and saying, hey, this is what I have going on. This is what we think they're eligible for it. Can you let us know your opinion? And then on the flip side to that, we saw some attorneys and accountants, issue opinion letters, to support the loan and say, this is how they're eligible for it. And kind of came down to, in those cases, that they may have been over the employee count of that 500, but they were one of the few exceptions that they could still issue a PPP loan for with it.
And I know it's only 2 bullets on the good things, but this actually has big implications when you had this, because it created a lot of assurances when, you used a separate, a separate avenue to kind of get comfortable with what we were looking at. So these were actually really positive.
So on the forgiveness side, one of the things that we were seeing is some disallowed expenses. Rent and mortgage interest, for the businesses, because, they weren't entered into after that February 15th deadline. The covered period in some cases that, the borrower may have asked, one of the early applicants said, I want that whole 8-week time frame. But when they go through the forgiveness calculator, there was some cases where there was a small portion of the loan that was going to be unforgivable using 8 weeks because of salaries, and they're capped at $100,000. But if they stretched it over a 24-week period, then they would have had the full forgiveness amount. And that kind of just, goes, as we'll talk about in a couple of slides, kind of hold the cost of, onboarding the loan and servicing of it. And then, as we've talked a lot about the due diligence, and what was performed, just with the SBA questionnaires, the borrowers aren't necessarily, answering the questions, or they're answering them inaccurately. They're not eligible to use one of the application forms, because maybe they had a reduction in full-time employees or salary costs with it. And then just kind of the support that was provided there, in some cases it was, well, this is, all that we had gotten. And, there should have been some more due diligence gone on. So, it comes down to the big question and the big picture is, what's the risk here? So the risk, if a loan amount is not forgiven, there's going to be some harm to the borrower, because, now they're going to have to make those payments. And yes, it's 1%, which is, and they can stretch it out over 5 years. So that's a positive there. But then, the banks have the cost of the whole onboarding and servicing of the loan. There's, the reputational risk, here with, any of the guidance that has been provided, and, if it's unforgivable, what's the cost? Because at the end of the day, we should be working with our clients, making sure that, they get the maximum forgiveness amount.
Yeah, and as David mentioned, the level of due diligence is important, and being able to understand, what your customer is requesting. We saw in the field, some customers who request forgiveness on smaller amounts, they leave an amount that's maybe unforgiven, but we look at the support and we're like, well, they actually, if they had looked at this, and this, they could have gotten the whole thing forgiven versus this loan. So I think that's, even though, different applications require different level of due diligence, just kind of think about what the impact to your borrower is, because, this was really meant to be helping them, get a free money, free government aid, right? And really the 1% loan is really more of a kind of a safety net for the remaining amount. So if you just, ensure that you're looking at the support and see, maybe help identify additional, amounts that your borrower can, look at. work with them is what we would say, just, to manage those different risks. As Sal had mentioned earlier, our office, provides services both, directly to banks as well as to, individual businesses. So this is actually from, one of our groups. We do have a COVID specific consulting group that both helps, has helped banks, process, inspect applications and look at underwriting, supporting the underwriting process. So that's definitely something, that we've helped with. But then on the flip side, we're also working with businesses to streamline, making sure that they understand, the rules and that they're gathering, the information. So, we just wanted to make sure that, everyone kind of knew that, we do have both service offerings available to, whatever may be needed. That really is kind of what we wanted to talk about. I know we're right at our 60 minutes, so but we'll definitely stick around for questions. If there's anything, Ashley, is there anything in the queue that has come through?
We had one question, will the slides be available to attendees?
Okay.
So yes, they will. We'll distribute a PDF with the evaluation form after the webinar.
Okay. Any other questions? We'll give a minute or two just to give everybody the opportunity to submit anything maybe that's unclear, share an experience that you guys are seeing as well with your institution.
Yeah, and if you just click on the bottom, there's the Q&A, should be next to participants. If you click on that, it'll launch the Q&A window, and from there you can put it in a question.
We kind of know that we threw a lot at you this past hour, but hopefully that there was some key takeaways here, and we'll just help you guys, help everyone, and go forward with this process. And if there's a round 3 or a round 4 of the PPP money or any other type of pandemic pandemic relief that comes out over the course of the next couple of months.
So there is a question that just came in, and the question is, do you think there will be any timeline forgiveness on adverse action?
So, I think, just thinking of some clients that have had this issue with, not being able to keep to a timeline and what they expect their regulators to comment. If this is what your question is, whether regulators will be more flexible if you exceeded 30 days or if you exceeded, are they going to forgive you for kind of not meeting all the regulatory requirements from a timeline perspective? We're not sure. It's going to vary by regulator. I think, how you identify these things, if it's, because you have a strong second line function that is doing independent testing, or if your department has self-identified this issue, being able to show your corrective action, trying to show your regulator that, look, yes, we had some deficiencies, but we've self-corrected, we've established these protocols. I think that's very helpful, right? Ultimately, it's the regulators who are going to, make that decision. But I think being able to show them that you have a good, strong, like 3 lines of defense process, where the business line is, looking for self-identified issues, so is the second, and so is the third line. I think that helps mitigate anything that may have gone wrong, during this whole process. And I hope that was the answer. I hope I interpreted the question correctly.
Yes, he said thank you.
Okay.
The other is a question: when performing an audit of the PPP loans, what do you feel is the most important aspect to make sure was completed?
I have a thought, and then David, you can give your thoughts. My thought is that whatever amount of loan you gave, your customer can then come back and get forgiven, right? So, I think that harm to the customer, I think, is probably the hardest part, because if you made a mistake in the originating side, it could be that then your customer is struggling on the backside. They may have gotten more money than they should have, right? So, they used it, so we can all make that argument. But then, they needed that money to survive. So it's already gone. They can't repay it. And now they're having a hard time figuring out a way to get it all forgiven. So I think that that's probably, for me, that was, more concerning because that harms the customer. In hindsight, there's nothing to do about it except, help them find ways to, get extended. So they were like part of that initial group that can have the option of the 8 or 24 weeks. You have some flexibility there, but it's lessons learned, right? So if there's a second wave of PPP or relief programs, it's making sure that we look at these kind of things more closely. When it was all happening, it was all chaos. No one understood the rules. It was kind of rolled out on the FAQs were rolled out on a Friday, and I think it started on a Monday. It was crazy, right? So, I mean, know that the regulators are going to take that into account. So I think at this point, it's more of kind of looking back and seeing what we can learn.
So I just want to add some commentary here. So I think, for what I was seeing is, just the whole due diligence that's being performed and, how the bank is, getting comfortable with the, with the support that makes up the loan amount, the correct costs being included, and things, because again, to Melissa's point, it's all going to go back into the forgiveness side of things. So if costs are included that aren't supposed to be included, are they going to be able to have a forgivable amount at the end of it?
Yeah, and I'll add too, like Melissa's point was that it was chaos in the beginning, right? We were thrown a program that needed to be pushed out immediately for the good of the nation. We did it, and we didn't have a rule book. For the first couple of weeks, then the money ran out. Then we had a little bit of a rule book, and then the rules changed constantly, right? So one of the things is to make sure you're benchmarking against the where you were in that giving out of the loan, right? So if you gave the loan out prior to these 10 new things, you need to just be able to document that in your files. So when you go to forgiveness, it may not be 100% match, but again, it was a good faith by the institution. Also, the other thing is on the forgiveness side is just making sure that you are properly looking for the forgiveness to determine, if the documents provided are adequate, right? Because you're not supposed to audit them, but you need to make a good faith, determination that they're not just giving you anything to get the forgiveness, right? There's got to be some review, and what we found in the beginning of the process, we really haven't done much as a firm on the forgiveness side yet from a review, helping some of our clients prepare their packages to send in. But when we were getting the applications and processing applications at Mercadien on behalf of our clients, what we were seeing is the documents coming in made no sense, right, from the applicant. So the thing is, if they're not making any sense and you made an application decision on that because you were trying to just pump the money out as quick as possible, on the forgiveness side, you really want to make sure that you understand the documents. So you understand those K1s that they're providing, or you understand the payroll reports, so you understand what is coming in. Not again that you have to audit it, but you have to make a good level attempt. So that's something from an audit perspective that we look at now that we're doing a few of the PPP loans as part of the internal audit process. And that's something we are looking at and making sure, is in play, even though that piece just started, right? So not many people have asked for forgiveness at this time.
Yeah, and I mean, David and I were looking at the forgiveness scope. And so, I mean, we're going to be looking at forgiveness throughout 2021 because it's 10 months after your covered period ends, right? So even like those customers that kind of barely got in August, it has to be the covered period of 24, weeks, then 10 months from that period. So we'll be looking at this, throughout 2021. One of the things is that a positive is that a lot of vendors have created documentation to help in this process. So like payroll providers are, creating output reports that help. So it's a lot easier because now there could be like a CARES Act report that gives us the right numbers. So it's better, right? So it's better from that perspective. So it's less complex or a little bit more straightforward than it was at the beginning. So, but yeah, we definitely take that into account when we're looking at loans. We understand, there was very little guidance at the beginning. So those loans are probably not as well, documented, but we expect to see progress, so if we're looking at a loan at the end of the cycle, we would expect the documentation standards to be very different from a loan, originated at the very beginning.
All right, so we have another question. Do you recommend any specific literature to read to appropriately develop an audit plan, since there were constant changes throughout the process?
I think the FAQs are for me, they helped us develop our test matrices because the register, the actual rules in the register, the way the regulators write them is in like these narrative forms, and they are good, but I think if you follow the FAQs, that's probably the best way to understand it because it puts them in context. So that's what we use, to make sure we understood the rules. We read it all, but I think I liked the FAQ approach because it was very robust.
Yeah, and the FAQs were very easy to, read and quickly search stuff and really understand it from that end. It's not fun necessarily to read, but, when developing your audit plan, I would start there with that and build off of those FAQs.
All right, so it looks like we're just coming up to the 2:30 mark, and we don't have any other questions in the queue. So what I want to do is say thank you to David and Melissa for the great presentation. Also, thank you for the attendees. We definitely had good participation here, lots of great questions. It is a moving target, right? And it continues to be moving and evolving, and so should your audit process, right? So, or your process to no longer take the applications, but to review them for forgiveness on that side. So continue to tread lightly, but move forward in the process as best you can. Document, as Melissa and David said, document your process, and do the best to make a good faith attempt at working through this crazy program and programs and time that we are in today. So again, thank you guys for the presentation, and thank you all for attending. Remember, please fill out the survey that will be coming out along with the PowerPoint presentation so that you can get credit. And we look forward to our next meeting, which Ashley, I think we have a date and even the topic for that. So can you just announce that, please?
Yes. So the next one is going to be on January 13th, and the topic is going to be on cannabis banking.
Yes. So in the state of New Jersey, for all the New Jersey banks out there, cannabis is now going to become fully legalized in our state. It also impacts a lot of the New York and Pennsylvania areas because you banks who are on the border of the states, may have some outreach into this program. And everything I've been reading about it, it's supposed to be a huge boom in industry in our state of New Jersey. We're supposed to have, I don't know, I read something from I think it was the New York Times that said $2 billion in revenue is expected a year from marijuana in our state through all of the growers and the distributors and whatnot. So they seem to have high hopes and high plans. So if your bank is not ready or does not currently bank cannabis, please log into that seminar. I think that'll be very helpful to the participants to just get a lay of the land of what cannabis is and an education. Mercadien has been working with this industry since, I'm going to say 6 years now. I think is when Colorado made it legal in the retail world. So we've been working with Colorado banks and their regulators to keep their program current, efficient, effective, to make sure that they stay in the good graces of the regulator, being that state and federal laws do not align. So we will be doing the same, giving you some outline in the next conference in January. So with that, we look forward to your attendance. Happy Thanksgiving to everybody, and we'll see you soon.
Great. Thanks, everyone.
Thank you, everyone.